$56 million in Bitcoin short positions got wiped out in a matter of hours this week, and Bitcoin is trading at $68,588 right now as this video goes live. Not a rumor, not a forecast, a documented dated event that happened on August 18th, 2026. Traders bet Bitcoin would fall, Bitcoin didn't fall, and the exchanges forcibly closed their positions, one after another, in a cascade that fed on itself. Here's the whole story in one breath. Bitcoin broke above $65,000 on a Tuesday morning, despite active geopolitical tension in the Middle East that should have, by conventional logic, kept price under pressure, and one trader alone, tracked on-chain by the analytics service LookinChain, had a $117 million short position partially liquidated for $23,360,000 in a single move. This channel does not predict where price goes next, in either direction. But this video will show you exactly what already happened, with names, dates, and dollar figures attached. Stick with me through all three parts of this story because each one tells you something different. The first is the mechanics of exactly how $56 million disappears in a matter of hours, and the second is the price history this squeeze actually sits inside of, which changes how dramatic the headline number really is. And the third is why this specific event is one of several nearly identical cascades that have already hit this market multiple times this year, on both sides of the trade. If you've ever bet against Bitcoin, or you're watching someone else do it right now, this event is worth understanding in detail. The mechanics behind a short squeeze are not unique to this week. They repeat, predictably, across every cycle this asset has ever gone through. Every fact in this video is sourced directly, dated, and named before each block, and I'll tell you exactly where each number comes from. I want to be precise about something before we start. This is not a video celebrating short sellers losing money, and it's not a video telling you to go along with leverage either. It's a documented breakdown of what happens, mechanically, when a directional bet meets a price move going the other way, because that mechanism is exactly what determines who survives this market long term and who becomes the next liquidation headline. There's one more thing worth saying plainly before we get into the mechanics. Every trader on both sides of this squeeze, the ones who got liquidated and the ones whose buying pressure liquidated them, believed they were making a rational decision based on the information in front of them at the time. That's not a criticism of either side, it's simply the reality of trading a genuinely volatile asset, and it's exactly why the framework you bring to a decision matters more than any single piece of information you're reacting to. Before we go further, here's the sourcing on the squeeze itself. The $56 million figure, the August 18th date, and the $65,000 price level come directly from Bitcoin.com news, published at 3:55 in the afternoon Eastern Time on August 18th, 2026, citing CoinGlass data. The specific on-chain trader example comes from LookinChain, cross-verified, through Forbes reporting published the following morning, August 19th. Let's walk through exactly what happened, in order, because the sequence matters as much as the total dollar figure. Bitcoin briefly reached $65,000 on Tuesday morning, gaining roughly 0.5% on the day and more than 2% on the week, pushing its total market capitalization close to $1.3 trillion. CoinGlass recorded $56 million in short liquidations tied directly to that move, a number confirmed independently by Bitcoin.com news the same afternoon. Here's the mechanism in plain terms, because understanding it matters more than the headline number alone. A short position is a bet that price will fall, and it requires posted collateral margin to stay open. When price moves against that bet, instead of with it, the exchange automatically closes the position once losses eat through the required margin, whether the trader wants out or not. Here's a detail worth adding about how quickly this actually unfolds once it starts. Unlike a slow, grinding price decline that gives a trader time to add collateral or manually close a losing position, a liquidation cascade compresses that entire process into minutes, sometimes seconds. Once enough, forced buying enters the order book at once. That speed is exactly why the dollar figures attached to these events can look so dramatic relative to how little the underlying price actually moved in percentage terms. Here's why this particular move fed on itself instead of staying contained. Every forced liquidation of a short position requires the exchange to buy Bitcoin on the trader's behalf to close it out, and that buying pressure pushes price up further, triggering the next round of short liquidations behind it. That feedback loop is exactly what a short squeeze is, and it's why $56 million can disappear in a window measured in hours rather than days. Here's why short sellers are structurally more exposed to this kind of cascade than long holders sitting on unleveraged Bitcoin. A short position has, in theory, unlimited downside, since there's no ceiling on how high an asset's price can rise before a losing bet gets closed out. Someone simply holding Bitcoin outright can watch its price fall without ever facing a forced sale, but someone shorting it with leverage is on a clock the entire time the position stays open, regardless of how strongly they believe the price will eventually come back down. Here's the single largest documented example from this exact event. A trader identified on-chain as gambler 0C96 held a short position worth $117 million in Bitcoin. As price crossed $65,000, 360 of those Bitcoin, worth $23,360,000, were forcibly liquidated, with the remaining 1,440 Bitcoin position, worth roughly $93,300,000, left open at a new liquidation price of $65,041.72. Here's what makes the timing genuinely notable, not just the dollar figure. This squeeze happened while geopolitical tension in the Middle East was actively escalating, following the expiration of a 60-day memorandum of understanding between the United States and another party involved in that situation. Conventional market logic says rising geopolitical risk should push a volatile asset like Bitcoin down, not up, and short sellers who positioned around that exact logic got run over by the move instead. Think about what the timing actually means for anyone who opened a short position specifically because of the geopolitical headlines. They weren't wrong to notice rising tension, and they weren't irrational to think it might pressure a risk asset like Bitcoin downward. They were simply on the wrong side of a market that, in that specific window, decided the geopolitical risk mattered less than whatever else was driving buying pressure that morning. And the gap between a reasonable thesis and the actual price action is exactly where leveraged positions get destroyed. Now, the bear case, because we cover it in every single block on this channel without exception. A short squeeze tells you about positioning, not about the underlying strength of the asset. And a cascade of forced buying from liquidated shorts is a completely different phenomenon from genuine, sustained demand. Skeptics correctly point out that squeezes can and do reverse sharply once the forced buying pressure runs out, and treating a $56 million liquidation event as proof of anything beyond shorts were positioned wrong at that specific moment overstates what the data actually shows. Here's the line worth remembering from this block. A short squeeze doesn't prove the bulls were right, it proves the bears ran out of room to be wrong, and those are two very different things. Quick mention before we go further, every trader liquidated in that $56 million event had access to the same charts, the same news, and the same data you have right now. And the difference between the ones who got wiped out and the ones who didn't wasn't information, and it was mindset under pressure, which is exactly what the Bitcoin holder mindset ebook is built around. It's normally $97, so stay to the end, and I'll hand you a code worth $50 off, bringing it to $47. Here's why that distinction matters more than it might sound like at first. Gambler wasn't necessarily uninformed about the geopolitical situation, the price levels, or the broader market structure. The on-chain data simply shows a position that was still open and still exposed when the move happened. Information alone didn't protect that position, and information alone won't protect your next one either, which is precisely the gap this entire video is built around. Here's the broader context this squeeze happened inside of, because a single day's liquidation number means more once you see where price has actually been. Bitcoin fell 54% from an October peak of $126,198 down to a June low near $58,000. From that same October peak to today's price of $68,588, the decline works out to roughly 46%, meaning price has recovered meaningfully off the bottom without erasing the broader drawdown. Here's what BlackRock said about the decline that preceded this recovery in writing, one day before the squeeze happened. The asset manager described the prior sell-off as largely driven by crypto-native deleveraging and shifting investor flows, rather than any fundamental change in Bitcoin's long-term investment case. That's a specific, attributable claim from one of the largest asset managers in the world, not an anonymous internet opinion, and it's worth hearing in exactly those terms. Here's what two other prominent voices said following the squeeze, again, attributed directly rather than paraphrased into something stronger than what was actually said. Anthony Scaramucci described sentiment as resoundingly bulls and said he expects Bitcoin to move above $100,000, citing what he characterized as conviction buying around the $60,000 level since January. Glassnode's data separately pointed to a similar read on accumulation behavior during that same stretch. Here's why this recovery context actually matters for understanding the squeeze itself rather than being a separate story. Short sellers positioning against Bitcoin in the weeks leading into August 18th were doing so after a 54% decline from the October peak, a moment when betting on further weakness genuinely looked reasonable to a lot of traders. The squeeze punished exactly that positioning, converting a level that shorts treated as resistance into the trigger for the cascade that liquidated them. Here's a way to picture the psychology of that positioning without dismissing it as simply wrong. After watching an asset fall 54% from its peak, extrapolating further weakness feels like the disciplined, data-driven read, not a reckless guess. The traders shorting into that $65,000 level weren't gambling randomly. They were following a pattern that had, up until that exact moment, been working consistently for months, which is exactly what makes the reversal so costly when it finally arrives. There's also a technical detail worth adding here for anyone wondering why the squeeze happened specifically at $65,000 rather than some other level. Round, psychologically significant price levels tend to accumulate concentrated clusters of stop-loss and liquidation orders, since large numbers of traders independently choose the same obvious level to place their risk management. When price approaches a level like that with enough momentum, the concentration of orders sitting there can itself become the fuel for exactly the kind of cascade this video has been describing, regardless of what specific news or catalyst gets credited afterward. Now, the bear case for this block, and it deserves the same weight as everything else in this video. Anthony Scaramucci and Glassnode both have a direct or indirect commercial interest in bullish sentiment around Bitcoin, and their public statements should be read with that context in mind, not treated as neutral, disinterested analysis. BlackRock's characterization of the prior decline as deleveraging rather than a fundamental concern is also, by definition, the asset manager's own interpretation, not an objective fact. And reasonable analysts have disagreed with that framing. Here's the honest, unglamorous version of this block's takeaway. A 54% drawdown followed by a partial recovery to today's $68,588 is a real documented price history, and what happens from here is genuinely unknown to this channel, to Scaramucci, and to every trader who got liquidated on both sides of this cycle. One more detail worth adding to this block, because it's easy to lose sight of amid the bullish commentary. A 49% decline from an all-time high, even after partial recovery, means Bitcoin still sits meaningfully below where it traded less than a year ago, and anyone who bought at or near that October peak is still underwater on paper, regardless of how positive this week's headlines sound. Recovery and full recovery are not the same word, and conflating the two is exactly the kind of imprecision that leads to poor decisions made on incomplete information. Organic engagement prompt. If this is the first time you've seen the actual mechanics behind a squeeze like this laid out with real names and numbers, hit like so it reaches someone else before their next leverage position. Subscribe, because we're tracking every one of these events as this cycle continues to unfold. Here's what connects this entire story to the reason this channel exists. Every single trader liquidated in that $56 million event believed, right up until the moment their margin ran out, that they had correctly read the market. I see the diamond is the phrase the Bitcoin holder mindset ebook is built around, the shift from reacting to a single day's price action with leverage and conviction to having a framework that survives being wrong about timing without being wiped out entirely. The ebook walks through exactly this kind of moment, a sudden move that punishes one side of the market and rewards the other, seemingly overnight, and gives you a structure for making decisions before that moment arrives, rather than during it. It's normally $97, and the $50 discount I mentioned earlier still applies, bringing your total to $47. I'm not giving you the code yet, because the final block is the one that shows this squeeze isn't an isolated event. It's part of a pattern that's repeated multiple times this year alone. Here's the specific thing this framework helps with that a price chart never will. Charts show you what already happened, and news shows you what's happening right now, but neither one tells you how you personally tend to behave, once real money and real pressure are both on the line at the same time. That behavioral gap is exactly what separated the traders who watched this squeeze from the sidelines from the ones who became part of the $56 million headline. One more sourcing note before the final block. The broader 2026 liquidation pattern comparisons come from CoinGlass-sourced reporting through Yahoo Finance, Prime XBT, and the Bitcoin Foundation's news desk, previously compiled and verified for this channel. Every figure cited is attributed to its original outlet and dated event. Here's why this particular squeeze deserves to be seen as part of a larger story rather than a single isolated headline. 2026 has already produced multiple 9-figure and 10-figure liquidation events on both sides of the market, not just this one. On June 2nd alone, $1.8 billion in leverage positions got liquidated in a single day, hitting over 272,000 traders, with long positions taking the overwhelming majority of that damage. Here's the mirror image of this week's squeeze from earlier in the year. In February, Bitcoin's futures leverage ratio hit 2.63% according to Glassnode, the highest level since October of 2025, immediately preceding a sharp downside move that liquidated longs instead of shorts. The mechanism runs in both directions. Overleveraged bulls get punished on the way down exactly the way overleveraged bears just got punished on the way up. It's worth naming the emotional asymmetry between these two versions of the same mechanism, even though the mechanics are identical. A long liquidation cascade tends to dominate headlines and feel more dramatic because falling prices and forced selling align with a broader narrative of fear that's easy to write about. A short squeeze like this week's event gets less coverage relative to its size, even though the same forced mechanical liquidation process is happening, just running in the opposite direction. Here's the pattern connecting all of these events, regardless of which side of the trade got liquidated. Every single one involved traders using leverage to amplify a directional bet, and every single one ended with an automatic, forced closure that had nothing to do with whether the trader's underlying thesis was eventually correct. Being right about Bitcoin's long-term direction and surviving the specific leveraged bet you made on the way, there are two completely different outcomes. And 2026 has now demonstrated that in both directions, multiple times. Here's a specific number worth sitting with, because it puts this week's $56 million in proper scale. The June 2nd event alone, at $1.8 billion, was more than 30 times larger than this week's squeeze, and it hit over 272,000 individual traders in a single day. That comparison isn't meant to make this week's event feel small. It's meant to show that $56 million, while genuinely significant to the traders who lost it, is a comparatively modest entry in a year that has already produced far larger cascades on both sides of the market. Here's why tracking these events as a pattern matters more than treating each one as isolated breaking news. If you only ever hear about the liquidation event that confirms whatever you already believe about Bitcoin's direction, you're getting a curated, incomplete picture of how this market actually behaves. The traders who survive multiple cycles are the ones who understand that both longs and shorts get liquidated with roughly equal mechanical indifference, regardless of which side eventually turns out to have been right. Now, the bear case for this final block, and it might be the most important one in the entire video. None of these liquidation events, this week's squeeze included, tell you anything about where Bitcoin's price goes from here, and this channel does not make predictions in either direction. A cascade of forced buying or forced selling is a mechanical event driven by leverage and margin requirements, not a verdict on the asset's fundamentals. And treating any single liquidation event as confirmation of your own existing view is exactly the trap that produces the next liquidated trader. Here's the honest truth sitting underneath this entire video. The $56 million liquidated this week is real, documented, and dated, and it tells you precisely one thing with certainty: that a specific group of traders were positioned wrong for a specific few hours on a specific Tuesday. It does not tell you what happens next, and anyone claiming otherwise, in either direction, is selling certainty that doesn't exist in this or any market. $56 million liquidated in hours, one trader alone accounting for $23 million of it. A recovery from a 54% drawdown to today's $68,588, disputed in its causes even by the institutions describing it. In a pattern repeated on both sides of the market throughout 2026 of leveraged positions getting forcibly closed the moment price moves against them, regardless of who eventually turns out to be right. Step back for a moment and look at what actually connects all three blocks of this video. A squeeze that punished short sellers this week, a recovery whose causes are genuinely disputed even by the institutions commenting on it, and a full year pattern showing the exact same mechanism running in both directions, on longs and shorts alike. None of these three things required bad luck or a lack of intelligence from the traders involved. They required exactly the gap this entire video has been describing: the space between reacting to information and having a tested framework for how you behave once real money is on the line. Every fact in this video came from a named, dated source, and every bear case was stated as clearly as the headline number. What separates the traders who survive events like this from the ones who become the next liquidation statistic isn't access to better information. Everyone in that $56 million event had the same charts you do. It's whether they had a framework for behaving well under pressure, built before the pressure arrived, not during it. Notice something about every single fact we walked through today. The precise dollar figure, the exact trader, the specific price level, all of it was knowable and verifiable after the fact, sitting in on-chain data and dated news reports for anyone willing to look. None of it was knowable in advance, to the traders who got liquidated or to anyone watching from the sidelines, which is exactly why a framework for behavior matters more than a framework for prediction ever could. Here's your code, as promised. The Bitcoin Holder Mindset ebook exists specifically for exactly this kind of moment: a sudden move, a headline number, a temptation to make a leveraged decision based on one day's price action instead of a tested framework built in advance. It walks through the specific behavioral patterns: panic selling, FOMO buying, and the overconfidence that leads directly into the kind of leveraged positioning that got liquidated this week, with practical tools for recognizing which one you're most vulnerable to before the market forces you to find out. The ebook is normally $97. Use the code HOLDER50 at checkout, and $50 comes off immediately, bringing your total to $47. The link is directly below this video, and the code is HOLDER50 before you complete checkout. This isn't a course you'll never finish, and it isn't hours of generic content unrelated to what you actually watched today. It's a focused framework built specifically around the exact patterns behind events like this week's squeeze, designed to be read and actually applied before your next moment of real market pressure, not filed away for some day when it's convenient. Here's the question to sit with. Somewhere right now, another trader is opening a leveraged position based on exactly the kind of one-day headline this video just covered, convinced they've read the situation correctly. If the difference between them and the $56 million liquidated this week isn't information, what is it? Do you actually have it? Let's walk through what we covered one more time before we close. On August 18th, 2026, Bitcoin broke above $65,000 despite active geopolitical tension, triggering $56 million in short liquidations in a matter of hours, with a single trader accounting for $23,360,000 of that total. That recovery follows a 54% decline from October's peak of $126,198 to a June low near $58,000, with Bitcoin now trading at $68,588. BlackRock, Anthony Scaramucci, and Glassnode have all offered bullish interpretations of this move, and each of those interpretations comes from a source with its own perspective and, in some cases, direct commercial interest worth keeping in mind. This squeeze is not an isolated event. It's one of multiple 9-figure and 10-figure liquidation cascades that have hit both longs and shorts throughout 2026, all driven by the same underlying mechanism of leverage, meeting a price move in the wrong direction. None of it predicts what happens next, and this channel will not pretend otherwise. One final thought before we close. The specific dollar figure in this video, $56 million, will be old news by the time the next squeeze or the next long liquidation event happens, and it will happen, because the mechanism producing these cascades hasn't gone anywhere, even though the exact numbers keep changing. What stays constant across every single one of these events is the gap between having information and behaving well under pressure. And that gap is the only part of this entire story that's actually within your control. If this reframed anything for you, share it with someone before their next leveraged position. Subscribe, because we're tracking every one of these events on both sides of the market as this cycle continues to unfold. I'll see you in the next one. This video is for educational and informational purposes only and does not constitute financial advice. Bitcoin and other digital assets are highly volatile. Leverage trading carries substantial risk of loss, and past outcomes referenced in this video do not predict future performance. Always do your own research and consult a licensed financial advisor before making any investment decisions.